Hey everyone, it's your guy coming at you straight from the studio. And today we are tearing the lid off a story that the mainstream media is completely fumbling. We're talking about China iron ore and a massive power play that just sent shockwaves through the global mining industry. Here's the headline from an American perspective. China just cut back on buying iron ore. So naturally, prices should tank, right? Nope, the foreign mining giants actually hiked prices higher. It makes zero sense on paper, which is exactly why we need to rip it apart American style. So grab your coffee, get comfortable, because we're going deep. And I mean deep. Let me set the scene for you. China is the world's biggest iron ore buyer by a country mile. They just slammed the brakes on negotiations with overseas mining companies. Under any normal market logic, when the biggest customer stops buying and walks away from the table, the seller panics and drops the price. That's Econ 101, right? That's what we learned in business school. That's what every American entrepreneur knows. When demand falls, prices fall, but reality did a complete 180. Global iron ore prices didn't fall off a cliff. Instead, foreign miners actually raised their offers across the board. Think about that for a second. You buy less, it should get cheaper, right? That's the law of supply and demand. It's not optional. It's fundamental. But when the big customer suddenly refuses to sign, these overseas suppliers don't rush to offer a discount. They act like you kicked their dog and jack up the price even more. From where I'm sitting, that smells like panic, not confidence. That smells like a bunch of executives in boardrooms sweating through their expensive suits, not knowing which way to turn today. I'm breaking down 3 killer questions that the talking heads won't touch. What exactly are these foreign miners so desperate to hide with this irrational price hike? Why did China suddenly pull the plug on global iron ore talks? And most critical of all, now that China is rewriting the rule book, how much longer can these overseas miners keep their fat, easy money gravy train rolling? And what does that mean for global commodity markets that we Americans also depend on? Because let's not kid ourselves, when iron ore prices move, steel prices move, and when steel prices move, everything from our cars to our bridges to our appliances feels it. So this isn't just a China problem or an Australia problem. This is an American problem too. Let's start with the cold, hard data, because numbers don't lie, and we Americans love our data. We love spreadsheets. We love analytics. We love breaking things down to the decimal point. After Beijing called off the talks, you would expect iron ore futures to crash. But the main contract on the Chicago Mercantile Exchange didn't plummet. It actually held steady near $96 per ton, flirting with that high mark over in Australia. Their offshore benchmark price also started climbing right along with it. Now, a lot of people's first instinct is to say, well, maybe China is running low on ore. And these miners know they've got China over a barrel, so they're using that leverage to charge more. But honestly, that idea is complete nonsense, because this has absolutely nothing to do with any real shortage whatsoever. And I want to emphasize that because it's the foundation of everything else we're about to discuss. If there were a genuine shortage, if Chinese ports were empty and mills were shutting down, then yeah, a price hike would make perfect sense, but that's not what's happening. Not even close. First off, check the stockpiles. Right now, iron ore inventories at all of China's major ports are piled up to a staggering 172 million tons. That's an all-time record high. Let me put that in perspective for you, in terms we can all understand, even if every single foreign ore ship stopped sailing into Chinese ports starting today, with 0 new deliveries. The ore sitting right there on the docks would be enough to keep every steel mill in the country running at full blast for over a month straight. That's not a shortage, that's a glut. That's like having your fridge so full of food that you could eat for a month without going to the grocery store, and then the grocery store raises its prices on you anyway. It's absurd. There is no hunger, no desperation, no we're running out of raw materials panic. None. Second, look at the production lines of these overseas mining giants. BHP just dropped their fiscal year 2026 results. And guess what? They didn't scale back. In fact, they ramped production to the absolute max and set a brand new record of 291.2 million tons. Vale and the other international heavyweights have also been keeping their shipment volumes consistently high. So let's add this up from an American business perspective. Ports are overflowing, foreign output is at an all-time high. Supply and demand are both showing plenty of product. So if there's no shortage on either side, what in the world gives these suppliers the nerve to push prices upward? That's not how free markets work, and we all know it. That's not capitalism, that's market manipulation. Plain and simple. I'll tell you exactly what's happening. These Foreign mining outfits aren't responding to real market demand. They're using their financial muscle to artificially prop up the market. They're deliberately pumping money into the system to create a fake perception that their ore is still in hot demand. This whole price hiking stunt is a smokescreen designed to cover up their sheer terror that they're about to lose their iron-fisted control over pricing before the big centralized negotiations even get underway. It's posturing, plain and simple, and as Americans, we've seen this kind of market manipulation before from all sorts of players. We've seen it in oil. We've seen it in precious metals. We've seen it in agricultural commodities. When a cartel feels threatened, they don't compete fairly. They try to rig the game, and that's exactly what these miners are doing right now, since it's all bluster. Let's dig into what these usually arrogant overseas miners are actually so scared of. A lot of folks don't have any real grasp on the insane profit margins in this business, and I'm talking Wall Street level greed here. Right now, international spot prices for iron ore are hovering around 95 to 96 bucks a ton. But according to the latest global mining assessments for 2026, the core mining regions in Australia, because they use open pit methods and massive automation, can dig that ore out of the ground, process it, and load it onto ships at a cost that's still crushed below $20 a ton. Let that sink in. 20 bucks cost, selling to China for $95, that's a gross margin north of 300%. You can go into high tech, you can go into internet startups, you can try anything, but nothing. And I mean nothing prints money faster than iron ore. They aren't selling rocks, they're sitting on a mountain of cash, just counting their billions while barely breaking a sweat. As an American watching this, I can't help but think about how our own tech or energy companies would kill for those margins. But even they don't have a lock on a single customer. Like these miners do, imagine if Apple had one customer that bought 70% of all iPhones. And that customer could just decide one day to stop buying, Apple would be terrified. That's exactly where these miners are right now. But here's the thing, even though they've been enjoying this golden goose for years, they're now terrified of a single, brutally fragile weak link in their business model, their total. Almost pathological dependence on one single customer, the Chinese market. Let me hit you with the latest customs and trade data for 2026. Australia exports over 70% of its entire annual iron ore output. And that flow has to go directly to China. If you look anywhere else on the planet, it doesn't matter if it's the US in an election cycle throwing money at infrastructure projects. And believe me, we Americans love our infrastructure. We love building roads and bridges and ports, or India and Southeast Asia, waving their flags about rising economic power. The hard truth is that not a single one of them can even come close to absorbing 70+% of Australia's massive ore output right now. They simply don't have the manufacturing appetite. We Americans might be building bridges and highways, but we're not buying that much foreign ore because our steel industry has its own dynamics. Its own domestic production, its own recycling capabilities. We're not going to save the Australian miners. The Indian steel sector is growing, sure, but it's still a fraction of China's size. Southeast Asia is developing, but it's not there yet. So the miners are trapped. They have nowhere else to go. And it's not just about market concentration. The miner's own backyard is getting shaky too. Take the situation as of early August 2026. The Port Hedland facility, which is Australia's absolute most critical hub for iron ore exports, is facing a major labor dispute and the very real threat of strikes. This single port handles roughly $800,000 worth of iron ore every single day, with persistent inflation putting pressure on wages and logistics, something we Americans are all too familiar with because we've been dealing with our own inflation problems. The miners' own supply chain resilience is actually deteriorating in real time. They're fighting on two fronts, external pressure from China and internal pressure from their own workers. That's not a recipe for confidence, that's a recipe for desperation. The foreign miners know, deep down, exactly how vital the Chinese market is to their survival. So why are they raising prices at this exact moment? It's a calculated gamble, a game of chicken, if you will. They're betting that hundreds of Chinese steel mills can't coordinate effectively. They're hoping that under the psychological pressure of this manufactured price spike, a few of those mills will get spooked, break ranks, and secretly run off to sign long-term supply contracts on the miners' terms. And the miners know if just one Chinese mill caves, they can use that as leverage to divide and conquer the rest of the industry, keeping the whole $20 cost, $95 selling price scam running indefinitely. It's a classic trap, and it's one that we Americans have seen used against fragmented industries before. Look at what happened in the airline industry, or in telecommunications, or in any sector where buyers were too disorganized to push back against suppliers. But China is about to flip the table, and when that table flips, the whole game changes. Now that we've exposed what the foreigners are afraid of, let's flip the lens and look at China's own calculation. Why did Beijing choose this exact moment to pull the plug on global negotiations? Honestly, the core motivation here isn't to go after BHP or Rio Tinto specifically. The real goal is way bigger. They're trying to solve a chronic, homegrown headache that's plagued them for years: vicious internal competition. Think about it. China has been the biggest buyer on the planet for ages, so theoretically they should have the biggest bargaining power. But in reality, hundreds of different steel mills and trading companies were all running off individually, negotiating solo with the overseas giants. So what happened? They ended up bidding against each other for the best ore. One mill offers $80 per ton, another jumps in at $85, and the foreigners just sit back and watch the price climb without lifting a finger. That fragmented, chaotic free, for all cost China a fortune over the years, a silent tax on their own industry. From an American perspective, it's like if every single car manufacturer in Detroit went to buy steel individually instead of forming a united front. Total madness. It's the kind of inefficiency that would make any American CEO cringe. You wouldn't run your business that way, and China finally realized they shouldn't run their country that way either. That's why this intervention is genuinely significant. Beijing has finally decided to weld those fragmented pieces into one solid iron fist based on 2026 import demand projections. The China Mineral Resources Group is currently doing something completely unprecedented. They're pooling over 600 million tons of domestic iron ore procurement demand into one single unified package to negotiate with the foreigners. 600 million tons? Let's wrap our heads around that number. That's a volume that gives them absolute, overwhelming dominance over the entire global seaborne iron ore market. It's essentially a state-backed mega group buy on a planetary scale. Imagine if Walmart, Amazon, and every other major retailer in America got together and said, we're all going to buy our products through one single agency and suppliers will deal with us or they won't deal at all. That's the kind of leverage we're talking about here. And the new rule is simple: no more backroom side deals. Any foreign miner who wants to sell ore into China now has to come directly to this central agency and hammer out a single unified agreement. The Wild West is over and China is now the sheriff. They're not messing around anymore, and every mining executive from Perth to London to Rio de Janeiro is feeling the heat. So why is China bold enough to drop this new rulebook right here in 2026? What's their real leverage? First, to support this centralized buying approach, China has been aggressively stepping up its own domestic ore production. The latest numbers show that in the first half of 2026, domestic raw ore output hit 161.6 million tons. A solid year-on-year increase of 1.3%. That's not a huge jump, but it's a steady rise that gives them a crucial safety buffer. There's an old saying, food in the pantry takes the worry out of cooking, with domestic production as backup, plus those record high port stockpiles. Again, 172 million tons sitting on the docks, and now a unified purchasing front. The buyers have unprecedented muscle. They can now stare down the overseas miners and say with total confidence, we can afford to wait. Can you afford to hold out? Because your ships aren't moving, your costs are piling up, your workers are threatening to strike, and your shareholders are getting nervous. That's a position of strength the Chinese side has never had before. And as an American observer, you have to respect the strategic planning here, even if we don't always agree with state-run models. You don't have to like the system to recognize that they're playing chess while the miners are playing checkers. And, the move is solid when even the most respected international consulting firms have to give credit. Wood Mackenzie, which is a huge name in global commodity analysis. Think of them as the McKinsey of the mining world. Released a report in early August 2026 that explicitly admits China Mineral Resources Group is now actively redefining how foreign mining companies exercise their pricing power. That's not me talking. That's their own words from a firm that advises half the Fortune 500 on commodity strategy. Now, a lot of mainstream media outlets, including some here in the US, have been running stories claiming China is doing all this just to haggle for a discount of maybe $10 or $12 per ton. But if you think this is only about getting a small price cut, you're completely missing the chessboard, this redefinition of the game, forcing the miners to sit down and squeeze the excess profit out of their inflated prices. That's just the appetizer. The real main course is China grabbing two absolutely massive strategic prizes in the future global trading system. And we Americans should be paying close attention because they affect our own commodity markets too, our own dollar dominance, and our own strategic position in the global economy. Let's break down prize number one, settlement and pricing rights. Have you ever stopped to ask yourself, China buys the ore, pays the money, and Australia delivers the goods? So why on earth does all this have to be settled in US dollars? And why does the price have to be pegged to that old Western Platts index? That setup has always put Chinese mills in a brutal double bind. Not only do they have to stress over daily swings in iron ore prices, but they're also constantly at the mercy of the Federal Reserve's interest rate policies and exchange rate fluctuations. And let me tell you, as an American, we might benefit from the dollar status as the world's reserve currency, but we also need to watch when other nations start chipping away at it. Because when the dollar loses a foothold in commodity pricing, that affects our own financial ecosystem, our own borrowing costs, our own inflationary pressures. It's not just a China problem, it's a global financial system problem. The Chinese have been squeezed from both ends for years, and they're finally fighting back. But that's changing right now. You might not have noticed, but back in April 2026, there was a milestone event in the mining world. BHP, one of the biggest miners on the planet, agreed for the very first time to anchor a significant chunk of their long-term contract pricing to the yuan-denominated port side spot index. That is a huge deal. It means the Chinese-backed Northern Minerals Index and the yuan settlement mechanism have just punched a massive hole in the US dollar's ironclad monopoly over global iron ore trade. Effectively, they're taking the pricing pen out of foreign hands and putting it back into China's, which will save Chinese companies billions in currency conversion losses and hedging costs over time. That's a power shift that cannot be overstated, and it's something we Americans should keep an eye on because when the dollar loses a foothold in commodity pricing, that affects our own financial ecosystem. We can't just sit back and pretend this doesn't matter. Every time a major commodity moves away from dollar settlement, the petrodollar system takes another hit, and we all know what happens when the petrodollar weakens. Our ability to project financial power weakens with it. Now, prize number two, what I call strategic supply chain credibility. In any global business negotiation, you can't just complain and protest. You have to prove that you have real alternatives. You have to show that you can walk away from the table and not starve. And China's physical, tangible answer to that is the Simandou iron ore project in West Africa, specifically in Guinea, after years of painstaking development. And I mean years of geopolitical maneuvering, infrastructure building, political risk management. Simandou is finally entering its payoff phase in 2026. Let me hit you with the latest numbers. In the second quarter of this year alone, monthly shipments out of Simandou broke through 120,000 tons, setting an all-time record, based on the latest production ramp-up data as of early August 2026. Total exports from Simandou for the full year are on track to hit a staggering 1.6 to 2 million tons. Now, here's the part that has Australian miners waking up in cold sweats at 3 in the morning. Simandou isn't just huge, its ore quality is absolutely top tier, with an iron content that pushes above 67%. That's high-grade ore, the kind that makes steelmaking more efficient, cheaper, and cleaner. And right now, China's entire steel industry is going through a massive green, low-carbon transformation. They're under pressure to reduce emissions to meet climate targets, to modernize their mills. That high-grade ore is exactly what they need. It burns cleaner, uses less energy per ton of steel, and produces fewer emissions. Meanwhile, the mainstream ore coming out of Australia right now typically only grades between 60 and 62% purity. It's not even playing the same game having Simandou as a reliable, high-quality alternative takes away the foreigner's last bit of leverage. From an American strategic perspective, this is like developing a domestic rare earth supply chain to break dependence on foreign sources. It's textbook resource security. We've been talking about doing that with critical minerals for years. China is actually doing it with iron ore, and that's a wake-up call for everyone who thinks resource independence doesn't matter. Now, let's connect all the dots when China brings this entire centralized purchasing package together: record stockpiles, rising domestic output, the Simandou alternative, and a unified front. How much longer can the overseas miners keep their comfortable, lazy, ultra-profitable business model alive? The answer is actually written in their own recent actions. Look at BHP's latest public guidance for fiscal year 2027. Their production target is still stubbornly locked at a massive range of 284 to 296 million tons. Think about what that means. Even though China is centralizing negotiations, even though they're putting on a tough public face and swearing they'll never slash prices, their physical production plans tell the real story. They absolutely cannot afford to cut back a single ton of output, because they know deep in their boardrooms that if they voluntarily reduce capacity, the market share they give up will be instantly swallowed up by Simandou or other competing producers. So in the face of brutal, undeniable market reality, they've already made their only choice: keep pumping at full speed, even if it means lower profit margins. That's a desperate move, and we Americans have seen that playbook before in our own energy and manufacturing sectors. When you can't cut production because you're afraid of losing market share forever, you're not in control, you're being controlled by the market. And that's exactly where these miners find themselves today. Now, you might ask, can't they just find other customers besides China to make up the difference? Sorry, but that avenue is completely closed. According to the latest shipment tracking data, this year's iron ore flows to markets outside of China have grown by an absolutely pitiful 0.5%. That tiny, negligible increase is nothing. It's a drop in the bucket compared to Australia's hundreds of millions of tons of annual production capacity. The plan to bypass China and find a new savior customer is already a dead letter. It's not going to happen. The US isn't going to buy that much more ore. India isn't. Japan isn't. Europe isn't. The global steel industry outside of China is simply not big enough to absorb what Australia is producing. And as Simandou's output continues to accelerate through the second half of 2026, steadily marching toward a billion-ton scale, the international experts at Wood Mackenzie have issued a pretty brutal forecast. In the coming years, those Australian miners with higher production costs and lower grade ore are going to be ruthlessly pushed out of the global seaborne market. A structural, no-mercy elimination game is already underway. And as Americans, we know what that means: consolidation, price volatility, and potential ripple effects into our own steel and manufacturing costs. When Australian miners start shutting down, global supply tightens, prices become more volatile, and American companies that buy steel, from construction firms to automakers to appliance manufacturers, could feel the pinch. So this isn't just a distant drama, it's a story with real consequences for our economy. So where does that leave us? China's stance is crystal clear. If you want to do business with the Chinese market, fine. You are welcome to come back to the negotiating table, but you will have to settle for normal, reasonable industrial profit margins, just like any other supplier in any other industry. The days of treating China like a bottomless ATM, jacking up prices with zero justification, and pocketing monopoly-level excess profits. That era is done. The twilight of the overseas miners' free money paradise has already descended, right here in 2026, and that's the kind of tectonic shift that the mainstream media, including some outlets here in the US, just doesn't want to talk about in depth because they'd rather give you a 30-second soundbite than a full analysis. They'd rather talk about political scandals or celebrity gossip than dig into the structural changes reshaping global commodity markets. But we're not like that here. We dig deeper. Let me give you one more layer that I haven't seen anyone else talk about. This isn't just about iron ore, it's about a broader realignment of global trade power. For decades, Western countries, including us Americans, have enjoyed the benefits of a global system where we set the rules, we set the pricing benchmarks, we set the financial settlement mechanisms. The dollar is the reserve currency, the Platts index is the benchmark, and the big Anglo-Australian miners call the shots on supply. That system is now cracking. China isn't just pushing back on iron ore prices. They're pushing back on the entire architecture of global commodity trading. And if they succeed, it's not just the miners who lose, it's the entire Western financial establishment that has profited from this arrangement for generations. The yuan's role in commodity pricing will grow. The dollar's monopoly will shrink. American financial institutions that earn fees from dollar-denominated commodity trades will see their business erode. It's a slow-motion revolution, and most people don't even realize it's happening. And think about the geopolitical angle here. China is building relationships in Africa, Guinea, specifically To secure alternative supply, that's not just about iron ore, it's about diplomacy, about soft power, about long-term strategic alignment. Meanwhile, Australia, one of our closest allies in the Pacific, is getting squeezed between its largest trading partner and its security partner. That puts us Americans in an awkward position. We want to support our ally Australia, but we can't buy their ore in sufficient quantities to replace Chinese demand. So we're stuck watching from the sidelines as Beijing gradually tightens the screws on one of our key partners. That's a strategic headache that Pentagon planners and State Department officials are probably losing sleep over right now. And yet, the mainstream media barely mentions it. So here's my takeaway for you from an American perspective. China is playing the long game. They're not just trying to get a better price on iron ore. They're trying to restructure the entire supply chain to their advantage. They're building domestic production, securing African reserves, consolidating their purchasing power, and pushing for yuan settlement. That's a comprehensive strategy, not a short-term tactic. And the miners, they're reacting, not acting. They're panicking, not planning. They're raising prices out of fear, not confidence. And when you're reacting out of fear in a commodity market, you've already lost. The real winners here are the Chinese buyers who finally got their act together. The real losers are the foreign miners who thought their monopoly would last forever. All right, that's the full breakdown from an American perspective. Drop your thoughts in the comments. Do you think the miners will eventually cave, or will they find a way to fight back? More importantly, do you think this kind of centralized buying could ever work in our own markets? I want to hear your take. And if you found this analysis useful, hit that like button, subscribe, and share it with someone who needs to understand what's really happening in the global economy. I'll catch you in the next one. Take care, stay sharp, and keep questioning everything, because the mainstream media sure won't tell you the full story. Peace.